Hello, everybody. I am Ari Afshar. I am pleased to be sitting across this Zoom camera from a friend and absolute expert in the space of multifamily investment, Max Sharkansky. Max, how are you?
I'm doing very well. How are you?
I'm awesome. I'm awesome. Staying busy, and I know that you guys are as well. And it's just a crazy time that we're living in. But I'm glad that you had a chance to take a few minutes aside for us. And as I've told you before, our goal here is to help educate our audience a little bit on what goes on and into the world of investing in multifamily. You guys have been incredibly successful, and we're going to learn a lot about that over the next 30 minutes or so. But before I jump in, I just wanted to share that the reason why we wanted to get Max and Trion to share their perspective on this particular vertical of real estate is because a lot of clients that we currently work with right now are either looking to invest or they are currently investing in multifamily residential real estate. And it's something that I just feel like for our audience to understand a little bit better and to know more from an expert is going to be very helpful for everyone. And of course, too, you are an incredible resource if they have any questions down the road. So without further ado, Max, why don't you just tell us a little bit about your history, about your past, how you came to be, and how Trion ultimately evolved into becoming a powerhouse in the multifamily space.
Thank you for the kind words. I started out way back when in the early 2002 at Marcus and Millichap as a broker. I was brokering multifamily in the San Fernando Valley. Did that for 5 years, and then naturally, because that's where my experience was, we started buying value-add multifamily in the San Fernando Valley. My partner is Mitch Pascover. He was working on the debt side at the time at HFF. Doing very large multifamily and other product type, but primarily multifamily debt transactions in California. And we always wanted to be on the sponsorship side, on the investment side of the business. So we started buying end of '05. We bought our first couple properties at the end of '05. We continued buying into 2006. And then at the end of '06, we left and opened up our own shop, Trion Properties. So we aggregated a small portfolio in the last cycle. And we had very fortunate timing, and we sold it prior to the crash. And as we were selling, we started to see the writing on the wall, and we switched our strategy from buying value-add multifamily to buying non-performing debt and REOs in the multifamily space. So we went from calling brokers and owners and just trying to buy value-add deals direct to actually calling the banks and calling asset managers. Because that was during the first wave of defaults. And we actually had some pretty good success during the downturn in 9, 10, 11, 12. We did about 20 deals, all bank deals. They were all bank, agency, and institutional deals. We did not buy a single property from a human being or any other sort of private owner. And then coming out of the downturn in 2013, we went back to the value add business because there was no distress left to buy. And then, ever since then, we've just been doing it more and more on a larger scale.
And so I know that you guys primarily started off here in Southern California, and Trion as a company has evolved into not only a larger company, but you guys are also now focusing slightly outside of the LA area and even California, if I'm not mistaken. So would you mind just sharing what Trion, kind of the inner workings of what Trion is and who you have on the team and why Trion really?
Sure. So we started out and we grew very organically. We started out in our own backyard, like I mentioned earlier, just buying in the San Fernando Valley, buying small apartment buildings in the San Fernando Valley. When everything exploded, that whole thing changed because you just had to go wherever the markets took you. So we were finding non-performing debt and foreclosures in Sacramento and Fresno and San Diego and all these different markets. And once you crack that seal of leaving your own backyard, you get a lot more comfortable with it. And then as the market recovered, we said if we should do more of this, and instead of just trying to find these deals that have been wrecked, let's try to find growth. Right? Because now the economy is recovering and there's probably going to be growth over the next 5 to 8 years. And let's buy in markets that have the strongest fundamentals. So we also saw not just strong fundamentals, but let's stay out of the markets that just got crushed, because we saw firsthand with our own eyeballs what markets got crushed. And our philosophy is, let's buy in markets that do well when times are bad, not markets that do well when times are good, because everything does well when times are good. So we stayed out of Phoenix and Vegas and a lot of these markets that just got crushed. And we were buying in the Bay Area and LA and San Diego, and then we moved up the coast to Portland. We tried to buy in Seattle several times, but we just got priced out. And right now we're closing on our first deal in Denver, Colorado. We've been trying to buy in Denver for the past year and a half, since January 2019. And all it took was a pandemic for us to be able to buy our first deal, because it had been so heated. We were in multiple best and finals and we just couldn't close on anything. And now we're buying a 288 unit asset at a very attractive basis.
288?
Yeah, it's huge. It's
wow.
24 buildings across 22 acres of land.
Whoa.
Yeah.
Is that like a university?
Yeah, it's like the size of a small city.
That's unbelievable. I mean, I guess you kind of answered two questions in one for me, which is why you're investing in the areas that you invest in, but also, you know, a little bit about the research that goes into investing in some of these markets. Because for me, you know, a lot of the conversations that I've had with investors in the past is they say that they won't touch anything that's not in their backyard for obvious reasons, right? They like to get in the car and drive and actually see the property that they're investing in. But obviously you've got a larger team, and this team you have of underwriters and ultimately people who are identifying the opportunities for you to provide for you guys to ultimately then look at the deal on a case-by-case basis and see if the fundamentals make sense for you guys. Then it's something that you guys would consider taking on. I see you waving off somebody.
Yeah, exactly.
No,
I'm trying to keep it out of the camera. Like, hey, I'm on a call.
Yeah, I've got kids running around in the background. We're obviously with the pandemic, life's changed a little bit. But you know, so the thing is you guys not only obviously invest for yourselves, but you now and over the last few years have been raising capital to help, you know, investors such as myself or people that are within our own networks to passively invest in these markets alongside your guys' operation and just not have to deal with the headache and, you know, whatever goes into every single transaction. So, you know, can you talk a little bit about that and your team that you have of who you currently employ to basically go out and do a lot of this nitty gritty for you?
Sure, that's a great question. So our organizational structure is fairly unique, unfortunately, and I say unfortunately because a lot of people who do what we do, they outsource everything. Third-party property management, third-party contractors, third-party everything. It's like 2-3 people sitting in an office or 5 people sitting in an office, and you know they're just outsourcing everything. So we are the exact opposite. We've got most of our functionality and our verticals in-house. So we're fully vertically integrated. We've got in-house property management, in-house project management. If it's a crew, if it's in California, then we use our own crew. If it's in Portland, Oregon, we effectively have our own crew. I mean, it's a GC. We've got 2 GCs that we use, but they do 90% of their business for us. So
right. So when you talk about crew, you're talking about the people that actually, once you identify an opportunity and it needs a lot of crew.
Sorry, construction crew. Construction crew.
Right.
The acquisitions team is in-house. The property management operations team is in-house. The project management team is in-house. So everything is done in-house. And that way we have a control on time, how fast it gets done. We have a control on costs also. But you can usually do it much cheaper and much faster than just outsourcing, because you're paying layers of profit to other people, contractors and subcontractors, and that starts to get really, really fat. So we're able to do things very quickly and very inexpensively.
And efficiently.
Yeah,
and I think that's the most important. Because that ultimately all translates to the bottom line, right? And what you're able to provide for your people who are investing into your group, right? And so to maximize returns, You just want to be as efficient as possible from both a time and cost perspective, which it sounds like you guys have done an incredible job. So when you're looking at a market like Denver, because it's the very first time that you're kind of abandoning, I'd say, the true West Coast, right?
Right.
That must have been a little bit of a risk for you. I mean, a 288, are you able to talk through that deal at all, or is it still kind of too new? And fair if not, but just
Oh,
in terms of like
sure.
acquisition costs and things like that, just because I want to help, again, just share with the audience what typical deal structures look like, and for many people who are maybe listening right now, they may not even care, but there may be the 2 to 3 to 5 who want to know if they do put in, and we're going to get into the minimums to invest with you, and what that looks like on an ROI perspective and basis. But a 288 unit building, I mean, I'm just thinking about here in Los Angeles, right? We're both from LA. I don't know where you can find a 288 unit building. But B, the cost would just be, just ridiculously.
$100 million.
Yeah, it is. It's $100 million property realistically, and that's on a good day. So,
Yeah,
can you tell me a little bit about this property in Denver?
sure. It's in a suburb of Denver, 288 units in LA in a suburb. Think of something you would see in like Warner Center or
Mm-hmm.
one of those very large properties in North Hollywood or Sherman Oaks.
Mm-hmm.
It was built in the 70s. It's been owned by the same person out of New York for about 8 to 10 years. They haven't done a ton with the asset. They're managing it remotely. The property management system in place is not a good one. So it's mismanaged. The rents are pretty low. There's some opportunity for us to increase the rents by improving the assets in the common area, improving the asset in the common area, like the pool, the fitness, creating a fitness center, rehabbing the pool, doing all new landscaping, rehabbing the leasing office, and then of course inside the units, we'll probably spend $7,000 to $10,000 a unit on new flooring, new kitchens, not a full kitchen, of course, because you can't do it on that kind of a budget. And I know these are numbers you're probably not used to hearing.
No, but I'm actually just doing the math right now for everyone who's listening. $7,000 to $10,000 on 288 units comes out to over $2 million of
Sure.
improvement. That's pretty phenomenal. I mean,
Yeah.
phenomenal in the sense of it's I'm sure stressful for you guys because that's capital outlay, and you're anticipating that you're going to be making that up through increased rents down the road and better efficiency on management. But it's a big risk, right? So you guys have proven time and time again, though, that it works, and so it's a system that obviously is functioning pretty well for you. So that's great. That's fantastic.
So it's like you said, like, yes, like the first half of your thought was it's a risk. And the second half of your thought is you guys have done it time and time again. So it's a risk, but it's a calculated risk. And for us, it's almost like a conveyor belt deal, right? Denver is it's our first one in that market. So it's slightly outside the box, but we've done 50 of these, over 50 of these. We've bought 5,000 units at this point. We've got, with this closing and a couple others that we're closing in the next few weeks, we'll have 1,700 units in portfolio. So
Wow.
we've done this many, many, many times, and we've been doing it for
Wow.
a very long time. Like I said earlier in the call, we bought our first couple at the end of 05. So we're now coming up on 15 years.
And your process ultimately, once you acquire these properties, is to rehab, bring it to its highest and best use from a, just obviously the rents that you're going to be bringing in, you are going to be maximizing fully, right? And so at the end of the day, it's your purpose is not to hold these for 30, 50, 100 years and provide that lifelong passive income. Your goal is to maximize every individual opportunity and return the money as quickly as you can to the investors. Is that right?
No, the business plan is different for each asset. It really depends on the size, how much scale we have in the area, what the quality of the area is, what the quality of the asset is. So if we find it to be a great asset, well parked, good unit sizes, good unit mix, in a great area where we see a lot of growth potential, then we'll hold it long term, because why not? What's the point of just selling it, cashing out, and paying a bunch of tax on it? you're better off keeping the asset and cash flowing on the unrealized gain. So we'll execute on the business plan in the first 2 years, do a big cash out refi, give everybody 50% or so, sometimes 30, sometimes 70 of their original capital contribution, and then you cash flow it, and you're getting growth over the next 5 to 10 years. So
those investors who invested in you early on, and you're providing that 30 to 70%, call it, cash out return, are you allowing them to continue to stay in the deal to realize the appreciation and the future growth of the, you know, of the rents as they go on?
of course, they own it. They own it. It's just like on a house. Like if you were to buy a house, fix it up, and then put a tenant in it and do a refi on it, you're doing a refi, taking the cash out based on the increased value. So it in no way changes the ownership structure. So everyone's on board.
So then talk to me, if you can, about, let's just say you identify a property, and just to make things very simple, you identify a property, you are looking to, the property costs, call it $5 million. I'm just using really simple kind of numbers over here. You want to, you want to obviously leverage, so you're going to be putting down, call it 40%, correct me if I'm wrong, but that would be $2 million on $5 million, right? Ballpark.
That's right.
So now on that $2 million, let's just say you're raising, you guys also put your own capital into each deal, or
we do,
is
yes.
it just kind of
we do. We put our own capital into each deal and into our fund. So yes.
So then what would a average, if you're kind of looking at the aggregate of all of the deals that you've had, if you're trying to basically pitch your case to investors as to why invest in Trion, what is the kind of your average deal to say, look, historically we have provided X for our investors, or, you know, here's what you can anticipate over the next, you know, 3 to 5 years. What would a deal look like? Is it like a 10% annual return on money? Is it 8%? Is it, and then, you know, your goal is obviously to cash out and to pay them a little bit back, and then maybe re-up in another deal. Can you talk through that a little bit?
Of course, that's a great question. So for the most, and of course every deal is different, but for the most part, what we tell our investors is don't expect any cash flow for the first 12 to 18 months, because that's the renovation timeline, right? So in the first 12 to 18 months, we're doing very heavy renovations. We're usually running the asset at low occupancy. So, you know, typical occupancy is, call it 95%. We're usually running at 85 to 90. So you've got reduced rents, reduced revenue, and, you know, call it by month 12, 13, 14, we're starting to stabilize the asset. We'll season the rents for a few months, and then we'll go to refinance it.
Got it.
So we'll refinance it, and again, depending on the asset, call it on average, you're taking about 50% cash out. So if you're putting 100 grand with us, you're taking about 50K out. And then you're usually cash flowing in the beginning, high single digits, so about 8, 9% on your remaining capital contribution. So if you've invested 100, you've got 50K left after the refi. And then on that 50K, you're usually making about $4,000 to $5,000 a year in the beginning. And then that grows as rents grow, which they do every year.
Wow. And so just again, the 50,000, so that first 50% of your investment comes back to you typically within a 12 to 18 month period of time, or is it closer to 24?
Correct.
And so then I guess the next question that an investor potentially may ask, or somebody who is interested in this as a concept, is, do you guys have minimums? Is it, you know, you're kind of just picking and choosing who you want, or are you allowing, I mean, is there a set structure that you have typically?
We have minimums. They're normally $50,000. And the best way to invest with us is through our funds. Right now we're on Trion Multifamily Opportunity Fund 2. We do occasionally open up deals direct to syndications as well. And you can invest in deals direct as well. But with a fund, it's really the best vehicle for an investor, because you've got automatic diversification across We had 8 assets in our first fund. Our second fund will probably have 10 to 12 assets in it. Then we'll go to the next fund. The economics are better, and our promote is crossed up. So if
can you talk about a promote, because
yeah,
I'm familiar with it, but can you just share with the audience what that is?
sure. So the way our promote is structured in the fund is based on how much you invest. So the more you invest, the less of a cut we take, and the more of the profit you keep as an investor. So we're gonna have a promote of somewhere between 20 and 26%, depending on how much folks invest. And that promote is crossed across all the assets in the fund. So what that means is if one asset does not do well, it will drag down how much we take from all the other ones. Whereas an investor invests individually in 5 different deals or 10 different deals, and one asset does not do well, it in no way has any
impact
relationship with any of those other deals. So it doesn't affect it. So we still get paid on the other
you're
deals.
de-risking it for the investors in a particular scenario.
Correct.
So that they're not, if something sours, they're still going to get, for the most part, the return that you originally forecasted, or close to, right?
Correct.
Now, we've obviously seen over the last, I want to say 6 months, it's wild that, this pandemic started really kind of February, March. But what we've seen is the stock market crashed, right? And then it bounced up like crazy, particularly tech stocks. Amazon, I think over the last month is up like 20%. Why should somebody diversify or not abandon tech or the stock market? Why real estate? Why is real estate such an incredible avenue to invest in, certainly from a passive income perspective?
There are lots of reasons. You just said one of them, cash flow. Number 2, the stock market, you mentioned that as well. It's very volatile. People tend to have poor control over their own emotions, and a lot of the times they'll sell low because they're panicking. Real estate is a non-correlated private asset, so you can't just sell if you're panicking. And if you look at our portfolio now, everything's doing great. I mean, our collections right now across our portfolio are in the mid 90s. April, May, June have been 95 to 96%.
Well, occupancy.
Occupancy. Oh no, collections. So occupancy has been around there, kind of 95%, 94%, and we're collecting 95 to 96% of that.
Over the last, you said 5 months?
3 months. Post-COVID. I'm just counting post-COVID. Normally,
that's phenomenal.
Yeah.
That's phenomenal, because when you realize that, certainly in California, governments essentially were allowing for tenants to defer payments and things like that, you're still collecting at a 95 to 96% rate. Is there any secret to that? Is it luck, or is it just good management? Is it a combination of everything?
It's definitely not luck. It's good management. You can't prepare for a crisis the day the crisis starts. And we've been well prepared going into it. We're very selective with who we rent to, where a lot of operators will rent to anybody, poor credit, poor income, doesn't really qualify to rent there. Those are the operators right now you're seeing who are having a really hard time, because those are people that couldn't really afford to live at their communities in the first place. So we've got high credit standards, high income standards, and now we're being rewarded for it.
And I think that a lot of investors, beginner investors, they love the idea of ultimately the 20 years plus or 15 plus years that you've been doing this. They feel like, I want to do this on my own. I want to be just like that. And I don't discourage that at all. I think everyone has their own path, and I think that everybody should do what they want to do. But at the end of the day, you have a machine, you have a system, you've got a tried and true business model that works. Why invest with Trion versus buying and managing on your own?
Well, there are a few reasons. First of all, what you just mentioned is we actually have an infrastructure, right? We have an acquisitions team, we have an operations team, we have a project management team, we have a construction crew. No individual can start from scratch and replicate that infrastructure. It's the same reason you use Microsoft Excel as opposed to trying to create your own spreadsheet from scratch. You're
I
not going
love that you still use Microsoft Excel when the entire rest of the world is on Google Sheets. That's how you know you're great at what you do.
Yeah. Well, Google Sheets is only going to take you so far. If you're running a 10-year cash flow model, you're not doing it in Google Sheets.
That's what I mean. Yeah.
Yeah, exactly. So it's just we have the infrastructure, or any like sponsors who do what we do, whether it's us or one of our competitors. You can't as an individual replicate the model day one. And also, most people have full-time jobs. They don't have time to go find a fourplex or duplex or an 8-unit building or whatever's in their budget and buy it and manage it and renovate it and lease it. And people don't have time for that. They've got lives, they've got careers, they've got families. Who has time to do that on the side? It's very, very difficult. It's a
Let
full-time
alone
job.
hobbies. Yeah. It's
Yeah.
there's a steep learning curve. You've already gone through it. You've built an entire assembly line like system around it that cost you a lot of money, a lot of headache, a lot of stress. And so it's investing in accelerating that process for a lot of investors. And then through those deals, what does your reporting look like? So how do investors know ultimately how deals are panning out?
Our reporting is great. We always get very high praise for our reporting. We do very thorough quarterly reports with a qualitative analysis, a quantitative analysis, explaining to the investors everything that's going on at the property, everything we've done with construction, with lease up, with income. That's the first page of the report. And then everything after that for the next 2-3 pages is the numbers. And it's pretty analytical, getting down to average rents per unit and showing how that's increasing. And then below that, we show the photos.
That's fantastic. And obviously you have a team set up to do just that. And so, just a couple more questions for you is, we talked a little bit about why an investor shouldn't or should feel free to do whatever you want. But at the end of the day, investing on your own is going to come with things that you've never seen before, right? Things that you may walk into, you're thinking, oh, well, instead of putting 100,000 into this thing, I'm going to, double that. I'm going to put 200,000. I'm going to buy my own 4-unit building or a 5-unit, whatever it may be. What is an example of a nightmare scenario that you've come across where you just thought, and this may have been in the early innings of you guys and what you've been doing, or maybe you don't even have one, but just moments where you thought to yourself, why am I doing what I'm doing?
I can give you multiple nightmare scenarios. For somebody doing this, you're going to get a lot of surprises because you don't even know how to do due diligence on an asset. So you don't know what to look for. As the great investor Howard Marks says, experience is something that you get when something you don't want to happen happens. And you're going to get things related to the systems. Plumbing, for example. It's a nightmare scenario when you have to replace the plumbing on an asset and you don't know how to look for that and you don't know how to cure that. And you have to have people move out of their homes if it's really bad. And if you get behind the walls and it's an older building, which it probably is in the city of LA, you have to test for and then remove asbestos. That's a liability. Then you're getting behind the walls, you're changing all the plumbing, and it's just an absolute nightmare. Regulatory issues, rent control, and everything that comes with that. Your tenants have a lot of control of the property as opposed to the landlord. So
Yep.
you might have some,
especially,
especially now because they don't have to pay you rent and you don't have a remedy for that. So you will oftentimes encounter very difficult, very unethical people who will go out of their way to give you a hard time. And you can't get them out. There's nothing you can do, even though you own the asset.
Right. And for just kind of like bringing that back to a novice investor, first time, second time, whatever it may be, you've got real cash in that deal. You were completely counting on all 5 of those units to be rented out. 12 months out of the year, let's just say, when realistically that can never be the case, because it's so hard to if you're churning a tenant, or if you know you have attrition, you got to make sure that one gets plugged in immediately. Otherwise, you lose rent that entire month, right? So
Sure.
managing that can be a full-time job in and of itself. And I've heard of nightmare scenarios where clients that I've worked with, you know, on just the residential side, they swear that they're never going to invest in multifamily again because of some of these experiences. I mean, uh, I hate using the term, but a squatting tenant basically can ultimately eat up your entire profit for an entire year of whatever you're projecting in year one. So it's things like that. And then in addition to that, another thought came to mind is, you guys are seeing deals way before a novice investor or a local broker who knows that you guys are going to be able to close the deal is going to bring that deal to you first. Obviously, you're working on substantially larger deals, but they're going to want to work with you before they work with me, right? They're going to
Good
want to
point.
present that deal to you. They're going to have the confidence to invest, or to want to accept your offer, even if it's slightly lower, versus mine, where I'm going to maybe try and write a higher number just to get into the deal. And then, but then they'll know that, you know, my due diligence period is probably not going to be as tight as your guys's, you know, because I didn't really think about the things that you guys have already pretty much factored in going into every single deal. So, you're going to be able to see a lot more opportunities. Those opportunities are going to provide a greater return for Trion as a group and the investors that invest in Trion. And I think I'm doing a pretty damn good job of pitching your guys' company right now.
Yeah, yeah, I appreciate it. Well, look, I don't think you're just pitching the company. I think you're pitching
The
investing with
concept.
others
Yeah.
as with other experienced folks as a smarter way to invest.
And
And
that's what it
absolutely
is.
right. And you know, that goes like part of what you're saying with regards to, yes, you know, the broker is of course going to show us or any experienced operator a deal, especially if they're great to work with and they know how to close. You have to know how to close. That's its own art form. And they're going to show that to us before they show it to an individual who has never done it before. That individual is going to go on the MLS.com or LoopNet and try to find something, and you're almost certain to overpay. And you know,
Yeah,
for us,
and
like,
I think that's well said, because we've talked in the past about other companies that are out there that are doing what you do, and you've always been quick to share your admiration for those other companies, and just, you know, give credit where credit is due. This is a function of educating the audience again on the concept of investing in multifamily, and why you should do it or why you shouldn't do it on your own, and what it typically would look like from an ROI perspective, a return on investment perspective, if you are investing with a company like yours. I have obviously a great amount of respect for what you guys do, because I've seen your guys' story over the last 15 years. We've known each other for a long time. It looks like you really have been staying pretty much on the West Coast, and now you're branching a little bit more into the middle of the States. What is your guys' vision for the next 5 to 10 years? Do you anticipate you ever entering into markets like New York, Chicago, or are they just too mature of markets to get involved with right now?
that's a great question. We are growing geographically. Denver clearly is the next frontier for us. As I mentioned, we have been trying to buy there, and we are now buying there. We close next month. We have been visiting Austin, and we're looking at Austin. We're currently underwriting a few deals in Austin. And there has been some conversation of opening an office in the Southeast, because that's so far from home. It would be hard to operate that from California with the time zones and the flight. And we're looking at opening an office in Florida, and we want to get into possibly South Florida, Central Florida with Tampa. It's a great market. We're looking at expanding into the Southeast, into Atlanta and the Carolinas. The Carolina, you've got the Research Triangle in North Carolina with Raleigh and all the schools over there with Duke and Wake Forest and UNC, Chapel Hill. It's a phenomenal market. And the political environment has become very difficult in California. So we want to diversify to California.
Yeah, and I think that that's important for investors to know is you haven't built a business model that is specific to one geographic location, and your business is either going to live or die by that. So I think that it's important to always be forward thinking. And yeah, this has been incredible. I don't know if there's questions that I'm not asking that maybe would be helpful for people to know, but I feel like we covered a lot here together. Is there any final thoughts that you have that you just want to share with the audience?
Invest in real estate. It's a phenomenal investment. It has outperformed the S&P 500 over the past 75, 80 years. So you will do well in real estate. I'm not saying you should only be invested in real estate, but you should definitely have an allocation of your portfolio in real estate. If you want to get a little bit more educated on real estate, feel free to go to our website, trion-properties.com, or you just go to trionproperties.com, and we have an education link with a lot of articles and blogs that a lot of us wrote here internally, just talking about the very basics of real estate.
And if you guys have any further questions, let me know. I'm happy to set up a personal introduction to you and to, do you want me to point people to you, Max, or is that, is there anyone else, or is it okay if I just introduce them to you as they come?
Yeah, you can introduce them to me. We've got in investor relations team in-house also. So they can call Andrew Lucas, that's A Lucas, or email Andrew Lucas, it's alucas@trionproperties.com, or they can reach out to you and you can set up the intro with either me or Andrew.
Fantastic. Well, I appreciate your time. This has been incredibly helpful for myself and hopefully for the others who are listening and watching this. And thank you so much for your time. And if you guys have any other questions, you know where to reach me. I'm at ari@ariafshar.com. Again, that's ari@ariafshar.com. Have a great weekend, everybody. Max, thank you again, and we will be talking soon.
Be safe, everyone.
Take care.
Talk to you soon.
See you.